Inside, please. Sriram, can we get everybody inside? We'll start. Yeah. Okay. Today we have the presentation by Vishal again, and this is a backed by popular demand kind of presentation. Some of you might recall yesterday's discussion about RSI changing the range from 30-70 and 80-20 to 40 and 60 and 40 and 60 respectively, acting as supports in a bull market or a bear market. And yesterday, late last night, we were discussing, Vishal and some of us were discussing about where you need to exit. And unfortunately, Vishal did not have time to finish it yesterday. So he is going to touch upon that today. Okay, he'll be touching upon that today. And his main strategy session that was originally built called intraday strategies by using candlesticks is going to talk about that. And then there will be he also runs a training institute in Mumbai. He will be talking about it for a while. And let's give him a good hearing. Thank you.
So can we start? So what we'll be doing is first we look at some candlestick patterns, and that will help us to put our exits in RSI also. So we'll take that later, what we did yesterday on RSI. Okay, now about candlestick, how many people use candlestick chart? Or how many use anything other than candlestick chart? 2, 3. So as we see that most people are using candlestick chart by default, right? That's the way of trading nowadays. And I've been using candlesticks almost since I was trading last 10 years, 12 years. And I thought I knew quite a bit about it because I've read those books by Steve Nissan. I'm sure everybody is aware about Steve Nissan. He's the author of 2 books on candlestick. He's the original guy who got candlestick to the Western world from Japan. Okay? But then I thought I knew, and I was teaching also. And last year I happened to just visit through Steve Nissan's site, and I came across a new program which had started on candlestick, and I thought, what would it be? I already know candlestick and I have already read his books. Still I thought that I'll get something out of it because I've been following candlesticks for a long time. So I paid like a bomb for the program and did it. And I found totally new perspective of candlesticks. Because remember one thing in trading, a trader keeps evolving and a market keeps evolving. So he himself, whatever he has written in last 2 books, which were 30 years back, he himself has changed few things about it, for which he has not written the book. He made a program. So from then onwards, my outlook towards candlesticks has completely changed. So there are some new insights to it. Some in that book there are some 60-70 candlestick patterns, and now he stresses only on few major important patterns which are most effective and can be traded. And some new insights from a different angle, how to trade candlestick from a momentum perspective. How does candlestick pattern fail and what is the implication of that? Okay, and many more. From that program I made a 2 full day program at my institute on candlestick program, and I already did 6-7 batches of that. So now we have limited time to do that, so I'll give you some glimpse about it, candlesticks, and especially this is related to day trading. So it will be very helpful in day trading as well as it will be helpful in any other time frames. As I said, any pattern or any system which works good, it will work on all time frames, most of the systems. So let's look at first of all, let's look at what really a day trading is. Many people here, especially the youngsters, would want to plunge into day trading, or I do get so many calls that do you teach day trading. Okay, and some people have that notion or that belief that you can't make money out of day trading. right? How many are there in that group who think that day trading cannot make money? Okay. So I would request that before any session or any training program, you should keep your mind open. If it fits you, it's okay. Otherwise, you can stick to your belief. Day trading can make money on a consistent basis if done systematically the way we do swing trading. Okay, so let's look at how we can do that. Now first thing is we'll just touch upon how does a trader evolves. Okay, initially when you come to the stock market, what is the motive? Money. So that's the greed part. Okay, so when you start with greed part, there are some problems. There are some problems from the market and there are some problems from yourself, right? What are those problems? First stage of a trader is greed oriented to make money. So you have, market is an unstructured environment and that is going to remain as it is. It's not a structured environment. So that's the only thing, because if you deal anything in life is structured. Structured in the sense everything has a fixed beginning and interval, like this session, this seminar. Everything is structured, you know when to come, when to go and all stuff. But when you enter market, there is no rule list or a checklist given to you that this is how you are supposed to enter and this is how you are supposed to exit. Because there is no fixed beginning and there is no fixed ending. Right, so you in that situation, you have to make your own rules of entry and exit and make a structure out of it. So that's unstructured environment is market. Constant information flow, which the amount of information you get in stock market through channels and websites and blogs and so newspapers is too much, which a human mind cannot digest or interpret at that speed, right? But we can't avoid in certain situations, or if you are trading in some trading room where there are many people who are trading or you have channels going on, then you can't stop it. I can do it. I don't have a TV in my office. I have never opened Economic Times in my life and not a single balance sheet I have seen. I just look at chart and trade. Right, so that's constant flow of information. Still there will be some flow. Somebody will call you and say that aaj ye lagta hai, without me asking him. Right? And then there is static analysis. What chart you are looking at it is kind of static at that point of time, but the flow of news is happening all around. Right? And what are the problems with ourselves as when it's stage one? I'm sure here there are some experts who are there, so already crossed those stages. But I'm talking about the initial stages of a trader where you have lack of discipline, over trading and random action and market noise. So these are the problems we have in stage one. What happens after this stage one? Of course, without knowledge, without discipline, random action will not make money or you lose money. So you go to stage two. You go to fear. Now what happens? Market problems remain the same. Market's not going to change. Right? Now you have different problems. Because you lost money earlier in stage one, now your over trading still continues by default. You don't want your money to be lying idle with the broker, a single rupee also. It should be fully utilized or it should be overutilized or leveraged. Right? So that's over trading. Then fear makes it worse. Then you'll have tight stop losses because you had a last time experience of losses, so now you get very cautious about your stop losses, and also you take your profits too early. And still you are not at that mark where you can make consistent money. And the third stage which comes is risk oriented. Right? The third stage is every trade I take, first thing I have to decide is what is my risk. There are only two things in the market. You buy a stock at 100 rupees, either it goes to 150, 200, 250, that's the reward part, or it goes down. Now going to 150, 250, 200 or whatever amount is anybody's control. No matter what the operator tells you, does he guarantee that it's going to 200? So the reward part cannot be controlled, right? But if you are bought at 100 and if it goes to 90 rupees, does anybody in the world stop you from booking a loss? Nobody stops you from booking a loss. Still most people lose money, in spite of risk being always in control of yours. Then who comes in between you and your booking loss? Your ego, your emotions. Because when you buy at 100 and sell at 90, you are accepting defeat, which human beings generally don't do or readily do. When they are forced to accept, then only they'll accept. You get that? That's why people keep holding on to losses for a long period of time and they are forced to exit. Right? So now, if now I become a risk-oriented trader, I know if it's going to rain, I have only option to carry an umbrella. I can't stop the rain. Right? If it rains, I'll open it. If it doesn't, I won't. So then I develop a method, like we already discussed some methods in the previous sessions, where there are objective rules of entry and exit. So you try to make a structure out of the market, right, out of unstructuredness, and then use effective money management, like how much you want to risk out of your capital, trading capital, and then develop that discipline to follow those rules or objectives which you have defined, the method. And then in this process, your own personality will change. If you become a successful trader, or if you are a successful trader, you have to, what has to be done with your own personality rather than the trades and the methods and the systems and tools. As you have already discovered, some of the tools and systems in the previous sessions are pretty simple to execute, and it gives fantastic returns. Still, it will be difficult to do it. Why? Because our own emotions, we are first of all again against human psychology to accept simple things. Like 3 by 5, I have a similar strategy, I follow that, and 3 by 5 is similar to that. You have simple entry, simple exit, and those figures are exceptionally fantastic returns. Just go and try and execute for another couple of months. How many can stick to it? Okay? And if you want to stick to it and get that result, your personality as a trader, as a human being has to change. Get that? So this is how a trader evolves from greed-oriented, fear-oriented to risk-oriented. Now whatever trade I have, first thing I will think about is the risk. If it fits me, then I will trade. If it fits into my system. Now I don't think about reward. Generally people give you tips and what the next question you ask, what's the target? Right? Instead of you should ask what's the risk. When the target comes, you don't need to tell, or nobody needs to tell you that you have to exit. Right? So let's see now, after that, let's look at day trading. Now what are the ingredients required to do a successful day trading? First of all, when you start day trading, you have to decide what will be the frequency of your trade. Frequency of your trade depends on the time frame you select. You select 5-minute chart, you select 15-minute chart, you select hourly chart, you select 2-hourly chart or any other number. The frequency of trades will decided by that time frame. And then you decide what is the size of the trade, exposure, which you can handle easily. Your trading capital. Now, what is the trading capital? Like, suppose I have 5 lakhs right now with me, and I require that money after 3 months for XYZ reason, say my son's education or whatever, but it is required after 3 months. So then I think that I have 3 months to trade that money and make it 5 to 6 or 7. But if it goes from 5 to 4, it is not acceptable because that has been allocated to something else, right? So that is not a trading capital. That is called scared money. A scared money will never make money. Okay? The amount of the capital which you can't afford to lose, then you can't trade. So trading capital has to be such that that's an extra money which you don't require for another at least say 1 year or 2 years. And if it goes down by say another 20% or 30%, then it does not change your lifestyle or it does not affect your night sleep. That's trading capital. Okay? Not all the savings which you have in your bank is your trading capital. Then what is the risk you want to run? So you have decided your trading capital, say 5 lakhs. You have decided the frequency of trade, the size of trade, and you have decided your strategy. Now this strategy, you must have already back tested, seen how it performs, and you know that what kind of losses and what kind of profits it gives. What are the string of losses you can have? So based on that, you can decide the maximum risk you want to take. Say at 5 lakhs, I want to take a risk of 50,000 or 75,000, which is 10 to 15% before I review the strategy. Because if I lose 15% on my strategy, doing several number of trades, then there is something wrong with the system, which needs to be modified or changed. You can't wait for your 5 lakhs to go to 2 lakhs and realize that something is wrong. And if you find out also, it will not be useful. So then you decide, and of course you need to have an intraday software, that's a given if you are doing day trading. Now what is the requirement of a day trading? Is first thing is volatility. Without volatility, you can't make money. So you can't do a day trading in something like an ITC or a lever or something stocks which are not moving more than 1% in a day. Nowadays ITC and lever also moves more than 2-3%, but I mean to say it should be active stock in terms of liquidity, volatility, operator interest or institutional interest, right? Or you can even make a fixed stock pool like 10 stocks or 20 stocks which are most liquid in Nifty, say State Bank, ICICI Bank, Reliance, L&T, BHAL, Reliance Infra, Reliance Capital and few more, and that becomes your trading universe for day trading. Okay, you cannot just randomly pick any one stock out of the 5,000 stocks and use it for day trading. So you make a universe of that stock, say 5, 10, maximum 15, and once you start tracking those 15 stocks on a regular basis, then you get the grip of that stock. Remember, every stock has a character. Okay, so to know the stock, you need to know the character of the stock, and you will only know the character of the stock till the time you keep trading it continuously for a few months. Like human beings, if I want to know a certain person, I have to be in touch with that person for a few number of months or weeks to know how he is, the characteristics. So make that list, 10-15 stocks, most liquid, most volatile. If volatility is what you are afraid of, then you are not meant for day trading. If you want to do day trading in silver, in commodities, then silver is the best option. You can't do a day trading in aluminum or zinc. Okay? Then how do you find stocks which are trending or which are volatile or your operator interest? Based on queries which you can run in your software. Queries will be based on volume, which has given a high volume compared to yesterday or last few days today. So that is the stock in action today. Based on price movement, say give me, you find out your search query and say give me stocks which are gone about more than 5%, 3% today. That means some action has happened today. So that is a likely candidate for tomorrow's day trading, right? And also momentum. If you are, say yesterday we did RSI, so give me stocks which has crossed 60 levels today. So that means that has high momentum, and that can be a candidate for tomorrow's day trading, right? So you can run queries Within the universe of stocks, you have say 20 or 30 of them. Then you have to devise the method that how are you going to day trade. Method will be having your parameters, that what are the parameters you will be using to day trade, which is say you only use RSI, you only use candlestick, you only use stochastic, whatever is your parameter, and then make entry signals with filters when to enter, when to exit, and then you make initial stop loss, and then how will you trail the stop loss, and exit conditions also if the target is met. Okay, this here you cannot do a trend following system within day trading system, because trend following system can lead to another day. Remember, decide to day trading, then it has to be over by the end of the day for sure, whether you are making money or not. At 3:30, that position which has been taken as a day trade has to be squared up by 3:30 for sure. Okay. Now we look at candlestick patterns which are most effective for short-term day trading, or even on a daily chart it will work. Now the best candlestick patterns to use on a day trading is all the shadows. All the shadow patterns which are doji, hammer, shooting star, all that, and it can be used in several ways. I'll show you that. Now we have shadows. So you have the ideal time frame what I use for day trading is 15 minutes times 5 minutes. Hourly will give you very less signals once a day, or maybe once in 3 days. Okay, and if it is rejected from bottom, you have a lower shadow. That's kind of a demand. Okay, they play a significant role in the trend status. So once you have a string of rally, and then suddenly you see upper shadows, that means trend is getting exhausted. There is constant amount of supply which is happening, right? Tall upper shadows are topping patterns, and tall lower shadows are bottoming patterns. Now you see there is a sustained rally in this. Strong candles without any shadows, and suddenly we have tall shadows, right? Remember, this can be a 15-minute chart, this can be a 5-minute chart, this can be a daily chart, doesn't matter. Okay, so we assume that this is a 15-minute chart. So we have a strong rally, and then you have 1 shadow, 2, 3 and 4. Signs of exhaustion, signs of concern, signs of trend getting over. So what I need to do is, I break the low of this shadow, which is like a huge, I short, and then I get 1, 2, 3, and then this can, if this is your 15-minute chart, and if this is which happens like this, so perpendicular, then you can take the help of 5-minute charts to exit. How will you exit 5-minute chart? Any time frame which you are trading, suppose you are trading a 15-minute chart for day, then your trade should not last for more than 5 hours. 15-minute chart, 5 hours means within your trade is over. And if you are using 5-minute chart, then your trade should be 25 minutes to half an hour. That's it. Extending you have taken a trade at 10 o'clock and you are still holding till 3 o'clock, that's not a day trade. Okay, day trading is about momentum and volatility, and volatility will rarely be there from 10 o'clock, 9 o'clock in the morning till 3:30 in the afternoon. It will come in sprouts in between, and that you have to capture. Okay, once I get my target, it can go further down after that. After consolidation, further go down, that's a fresh trade. One trade which you take, which is 5-minute chart or a 15-minute chart, 5 bars, maximum 6 bars should be over. Again same thing, strong rally, and then you have 1, 2, 3 shadows, all So I wait for another black or break of those two dojis, trade. Where would I have exited is if this is a 15-minute chart and this is also 15, so this goes like this, so no problem. This goes like this and again closes higher. So I cannot lose this much money on the table. So I go to a lower time frame, 5 minutes, and wherever I cross the previous candle's high is my exit. Clear? Anybody not getting this? I shorted as soon as low. Okay, on a 15-minute chart. Somewhere. Stop loss will be the high, of course. Right, that's clear. Now I go, this goes perpendicular, so I don't have any problem. This goes sharp like this. So this candle which is having a long up will have, if you convert that into 5 minutes, black, then another black and another white which is coming up. Right? So if that white will cross the previous candle's high, that is your exit. So you will exit somewhere maybe in this area and not at the close here. Okay. So that trade lasted for only 2 candles. That's it. Then let it go here. That's a different thing. You should not get judgmental. You should not get carried away by the flow of the news. If you are making 0.5% on a trade, on a single trade, that's quite amount of money. If you do 3 trades in a day, which if you use 5-minute, 15-minute chart, the stocks are volatile, something like Bank Nifty, at least you will get 2 or 3 trades in a day. Exception are like 15 days you might not have got, or you might have got only 1 trade a day. That's fine. You wait for the perfect moment to enter and not just trade to a day trade. Okay? It should not become an addiction. It should not become a compulsory trader because I am sitting in front of the screen, I have to trade. If there is an opportunity, if there is a situation and the systems are combining together, then only I will trade. Then let's look at doji. Open and close are same. So let's look at kind of doji. Remember, any breakout which happens very often nowadays, it is like a doji. So in terms of price, you have a right, but in terms of strength, it is not. So I will not be convinced to buy this kind of breakout. Okay, I will wait for a white. If there is a breakout, it will be white, means total bull control. This is not bull control. Okay, so I will be cautious, and in fact, there is a higher. I will trade the failures than the breakouts actually. So this, if works out up, that's fine. You can trade it because that's not part of your system. But if it works like this again, then I would love to trade that. Something like this, it goes back in within 1 candle. That means it was a false breakout. I will short on this with a stop loss above this and take. There is a gap up, so this day was over here. I will square up my position at the close. No matter my position is in favor or not, I will not carry the position. Day trader means day trading. It should not carry forward. Right? These are the kinds of dojis we see and different names suggested in the books. Names are not important. You have to understand the concept. There are some fancy names. It's okay. Now, before I see a doji, what is it? Is a trend. See market, which is any time frame, hourly or 15 minute, the dojis are there, but they are not after a trend. What I consider as a trend, at least I need 5 candles directional. As I've shown here 3, I need 5 directional candles, and if I have a doji, whatever time frame, 5 or 15, then I consider as a trend, and if that doji breaks, then there is a trade. The sideways market, any candle pattern which is a part of sideways market will not make sense. It will be white only. if there is a small black here and then it continues up, that's fine. It should be a strong trend on a 5-minute chart. So on a 5-minute chart for a strong trend, Bank Nifty can be only 50 points or 70 points. Then you doji, ideally another doji, and then you break that short trade. Ideally, what I can do that I have shown you that RSI concept also. So you not any trade which is between 40 and 60, right? If the trade comes above 60 or below 40, then I will take. That means the trend, that there is a momentum in the stock and there is a trend. Dojis are more effective at the tops rather than the bottoms. When I see doji like this, which is in the same area as of previous, along with the huge volume, that gives me more confirmation. Here it can be aggressive. And then confirmation of this below the low, it is confirming two things. One is the support or one is the resistance, one is the doji pattern and one is the volume. So that says high level of indecision with high volumes at a resistance is a high probable trade for short. Clear? And then I short, again this is a 15-minute chart, I trade short, and on this 5-minute, as soon as a 5-minute bar is crossed, I will take it out. Now here again, I have a series of trend, uptrend, and I reaching a resistance. I see a big volume, right? So this high probability trade is on the cards. Once the doji low breaks, remember you see doji here, 1 and 2, but none of them got confirmed, and none of them had the resistances, and none of them had high volume. So now I have doji which has a high volume as well as at resistance. So I wait for a break of doji to short and exit be similar stuff like this, and if it continues you can continue the 3 or 5 bars, and as soon as it gives a pullback, out. You don't need any other further tools other than candlestick at times, or maybe at times you can volume confirms. If you mix up, if you use 5, 6, 7, 8 tools, more than 4 tools in day trading, it will be very difficult. Simplicity is the key in market to make money in any system, in daily, weekly, intraday. Make it as simple as possible. If you are not bothered about volume, don't take it out. It's okay. Now, here we have series of doji. What is the trend I have? It's early in the trend. I just have a 2 candle trend and then I have series of doji. So is this an ideal candidate to short? Because there is no trend already. There is not a substantial trend. Okay. So when I have a situation in this case, what happens generally when we look at doji after the we tend to get bearish. We think that it is exhausted. Now we are ready to short. But remember, when a doji comes in early part of the trend, it can also act as a pause. Okay, as a pause, and it can resume the uptrend like this. So if I have an early doji in the early part of the trend, and then if it resumes like this calls for a buy. Because after all this indecision, market has refreshed, or the bulls are back in action. Okay. Now, how do you do momentum trading without using momentum indicator? Using candlestick patterns, similar to what we just saw before this, that I have a strong downtrend. Okay, it's a strong downtrend. There is no doubt about that, and I am also at a support. I have doji. So what is my plan of action for tomorrow? Buy, sell, no buy, no sell. Anybody for sell? So,
why stop at reverse?
Right. Okay. We'll see that whenever you are at a doji and it is an important support, generally we tend to think in one direction because it is a support, it's a doji and it's a trend. So we think that abhi now there will be a trend reversal, right? And then we are ready to buy. So we go with one plan in the market that if it crosses, I will buy. And if it goes below the doji, you don't take trade because you have not made that plan. Right? You have not made that plan, so you just keep watching the trade. And then what happens is, you have a swift down move, which actually breaks the support and breaks the doji also. So this is a momentum trade. Because market halted where it should have, it showed that indecisiveness, it gave respect to that support. Bulls tried to came in, but they were not full and bears took over again. So that calls for a momentum trade without using momentum indicator. Is this a decent trade for a day trading? You get two candles like this big. In fact, this is actually not a 15-minute chart, but it's a daily chart. But the same thing happens on 15-minute chart. On a daily chart, you get a momentum trade of say almost 400 points on Bank Nifty without using any other oscillator also, any other tool, and just candlestick. Break of low. Because break of is not the entry because immediately you have a support. So all the lows are broken, that's a momentum trade. Close, if it breaks by a tick also is your entry is gone, entry is done. Because intraday you don't wait for a close of the candle for 15 minutes, by the time the move is already over. You have to take trades on the break. Now, once it breaks the low, okay, and it again goes above the doji or at least the previous close or that opening, this is the opening of this candle and this is the closing of previous candle. If it starts trading above that, whichever is lower is your stop loss. Now, what will you do after this strong rally at resistance, 3 indecisive candles? What is your outlook for tomorrow? Is momentum trade without using momentum tools. If you try to combine anything else, might not work out. For day trading, you don't have that much time to analyze that many tools and take a decision. It's in that second, if you have traded or you have missed the trade. It's microsecond. If you can't take that quick decisions, then you are not fit for day trading. Then we look at hammer, simple hammer, upper shadow, lower shadow with upper body. What is the psychology of hammer is, bulls are getting in charge and bears are losing momentum. Lower shadow is a strong support. So whenever you trade a hammer, the low of hammer is your stop loss. Any candle pattern you trade, low and high is your stop loss. Now what you have is a trend which is like 5-6 candles down and running into a window which is like a gap and then you have a hammer. Okay, so I have two confirmation, one window which is acting as a support. I hope everybody is aware that gaps always act as support resistance and we'll see that in this presentation also. And when you approach a gap and then you see a bullish candlestick pattern or a bearish candlestick pattern as per the trend, then that's a very high probability trade. Gaps are most reliable patterns to trade in terms of candlestick, in terms of intraday, in terms of daily also. Gaps are very important. So your confirmation on hammer is your buy, and whenever you get your 5-minute signal you can trade. See, I made this presentation for actually end of day, but the same thing can be applied on day trading. The same situation, forget the time frame of the chart. Again you have a hammer, you had two earlier hammers also, right, which didn't get confirmed. What is the confirmation of hammer? Trading above the high of a hammer is confirmed hammer, then only I will buy, right? So I had two hammers and then I have third hammer. Now this means that every time market goes down, since last 3 periods, there is demand. And we are also at an important support, and this time it is supported by volume. Right? So this is a very high probability trade again. Hammer at support with high volume, and I buy above the high of the hammer. And if I get 2 candles also fine, and exit at the low of the previous candle. And then again you can enter the same trade if it crosses this shadow. You will see in shooting star. Now with hammer also you can do momentum trading. I have a similar hammer like to the previous candle, previous slide, with huge volume. So what would be the inference again? That I should be looking for a long trade. Right? Not necessary. If it goes down, what you do? You don't do anything. But if it goes down, it converts trade into a momentum trade on the downside. Right? So what I suggest is, or what I recommend is that every day when you go in the market to trade, you should always have 2 plans, because only 2 directions market can go. Based on the analysis we do, or the candles we look at, or any other pattern or any other system you follow, which is discretionary kind of thing, then you have made your view about the market with the previous night or previous day, and then you go with only one view of the market and say that if this breaks then I will sell, or I will buy if it breaks. But if you go with 2 perspectives, then life will be easy, and then you'll never find market confused or surprises. We get surprised. Why we get surprised in the market? Because market did something which I was not expecting, or which I was not prepared to handle. Right? But if I have 2 plans, I am not surprised, because above that I would have bought, below that I would have sold. Clear? And especially for short day trading, you should have both the plans ready. In case of trend following, you don't have an option. Whenever your signal is generated, you'll be buying or selling. Now again, you have a good hammer right at a support after a strong decline. So I make a plan. If it goes above, buy. Goes below, it's a strong sell. As a trader, or if you are new to this, what the same mistake I used to do, that whenever price approaches a support, we assume that the support is going to hold. Subconsciously or whatever, I don't know. I used to trade that now support has come, there is a hammer, so I am definitely going to buy tomorrow, or I in fact already bought at the end of the day. Right? And if next day it goes down, at the most what I will do is stop out. But now if I make 2 plans, not only I don't take the trade in anticipation, and I also take advantage of the other side which happens, and I am prepared for both. Then the same thing is for shooting star. Bears getting aggressive and bulls are losing control. So high of the shooting star is a strong resistance. So you have a strong rally and then you see a shooting star. Higher shadow, that's supply. So on that confirmation, I will trade short below this, and as soon as I get my price, or I approach a gap, or I approach a support, or with a 5-minute confirmation, I take out the trade. Again a shooting star after a sustained rally, and then confirmation. So 1, 2, and exit with the help of 1 minute. Again with shooting star you can do momentum trade. You have a strong rally and you have a shooting star, and if the high of the shooting star is taken off, that calls for another refreshed trade on the upside, that bulls have again taken over, like this. In a single candle makes that kind of move. Again one shooting star after a strong rally. Now it's a strong shooting star with big shadow. So I normally again assume it's going to a downtrend or not going to an uptrend for sure, and it happens to be, and then we keep just, and it calls for a momentum trade. So what we look at is I have a shooting star which didn't work, trend resumed. Till now we only look at reversal patterns, right? That if there is a doji shooting star, I trend reverses. Now we are looking at a trend continuation. And remember what I said yesterday is in RSI also, we are looking at is something which is already trended, and we get an end to that existing trend. There is a higher probability of making money because we are going with the trend, right? Now comes the windows. Gaps in candlesticks. We have rising window acting as support and falling window acting as resistance, like this. You have a gap up. So this area becomes the support, and if there is a gap down, then this area becomes the resistance. Now, after going down and when it approaches gap, what am I looking for is some kind of bearish candles where I can take action, because it is candle also bearish and there is a gap also. So let's see some of them. There is a huge gap, suppose this is a 5-minute or a 15-minute, you have a gap here and market comes into this gap and you have a kind of inverted hammer and a bullish engulfing pattern. So it is at the right place at the right time, and then I get confirmation and I get my trade. So windows act very good in all time frames of the market. A 5-year gap which is not filled 5 years back, and when price approaches that gap, it will work as support. Again you have this as a gap and market goes up and then comes here, and then you see small t at support and confirmation, right? So that gaps always act as supports and resistance. Again you have a gap here, market goes up and comes down and a hammer at gap support, then you get a confirmation 1, 2, 3, that's it. So that's kind of gaps are very important on all frames. They work fantastic. Now, similar just to make it objective way of trading, what is, we have seen all the patterns which are possible. Okay, so what I look at is method 1. I need, there is minimum 5 trended bars in either direction, up or down. Okay, and the 6th bar has a shadow bar. Shadow means kind of doji, shooting star or hammer or spin top. Okay, called the signal bar. Ideal if there are 2 in a row, 2 in a row. Ideal time frames 15 and 5-minute chart. Okay, something like this is the setup. You have 1, 2, 3, 4, 5, and then you have 1 shadow or 2 shadows are ideal, 5 minutes, 15 minutes. So what I need to do is, whichever is the best in this is my entry. Means if this breaks, I sell with a stop loss above high, highest high. So that's my setup for entry. On a day trading, I need minimum 5 candles in a row, which are higher highs and higher lows. No size market or no range bound market. Minimum 5 minute or 15 minute. And similarly on the downside, I need 5 down. Ideally 2 shadows, 1 is also fine. 2 will be great. And I buy above the high of this, the low of as a stop loss, and then ride whatever I get in next 3 or 4 or 5 candles. So entry is an uptrend break the low of signal bar, and in a downtrend break high of the signal bar. Signal bar is your shadow bar, and stop loss is high and low of the signal bar, the bar which you have traded. So your stop loss here, where? If it goes above and again goes down, then that's a stop loss. That's exactly what I was about to say. Because if there is a trend, and we have explained that momentum, suppose you buy above this, and it does not go much up, and then breaks this, that can act as a stop and loss, because then the trend resumes on the downside, and there was a false breakout. If there is a false breakout on the upside, then the next trend on the downside will work out for sure. No. Exit is trail stop loss high of the preceding bar. It can be the same 15-minute chart, or you can reduce if the bar 15-minute bar is too high, like a 100-point bar in 15 minutes. Change it to 5 minutes and put a low below that last bar. That's your trailing stop loss. Or if you think the time is up, means you are nearing 320, then you can exit momentarily. Okay. There is a method too which says there is a window and intraday chart, like the ones which we saw. Ideally 15 and 5 minutes again, and then we see a buying confirmation on bullish candlestick and bearish confirmation on bearish candlestick, something like this. I have a gap here and market here, and I get a bullish candlestick pattern, and above that I buy with a stop loss below this low. Again, you can write the trend with last candle's low as your stop loss. 1, 2, 3, 4, 5, 6, 7, 8, 9, and the last candle low breaks, that's your exit. Or if you use the time frame from 5 minutes, you can take there. Point is to, once in intraday, if you are making money, and then if you end up losing money, right? Okay? If you are making money, whatever way you can protect it, you protect it. Okay? So once you are in the money, you should not go out of the money. Worst case, you can break even. So that was method 2. You have a shadow on those, and we can see exit monetary also. So that was a brief on candlestick pattern, which all the patterns which I showed you is equally effective on all time frames, including 5 and 15 minutes, with 2 methods in place.
Vishal, great presentation. I don't have any issues with EOD charts and candlesticks, it is superb. But I have a basic fundamental question on day trading candlesticks.
Okay.
I know is, in a candlestick chart, huge emphasis has been placed on the open and the close. That's why we get the real body, and the high and low comes as wicks.
Yes.
So the original logic is the actual price action is within the body,
Right.
where the wicks are and euphoria in that particular bar.
Right.
Second logic is, when the opening price comes in the market, nobody is forcing a gun to my head to buy. So whatever trade I do at the opening is more by free choice, and rather the closing is at the point of a gun. Because if I have a position on a day trading scenario of money, I can't take it home. My question is, the whole concept of candlesticks is based upon the basic philosophy for the open and the close. Hence the candle gets formed. That's why it works superbly on a day basis. But on a real-time basis, even if I'm trading on a 5-minute or a 15-minute candle, the next candle's open is just the next rate which comes in. So the philosophy behind the opening price, is it applicable on a day trading scenario? Opening price of a bar and the closing price of a bar is also based on that time, the last tick which is coming in. So the traders who are there in the market, the participants, they are forced to square off their position at that particular bar. Right. This is the critical aspect. Secondarily, when we have a gap on a day trading chart, maybe there was a huge stop loss there. So then we had the gap when the price jumped up. But a gap on a UOD basis means there was a huge demand out there which gets met when prices are and all. Thirdly, when I use candlesticks on a day trading chart, whether on currencies, whether on commodities, whether on stocks, candlesticks do not follow the pattern of EOD. They are absolute, going on in random. I have 3 candles like hammers, pure dojis, then the price continues. Whatever patterns we see as coming out or topping out patterns, my belief, whenever we see it on short time frame charts, 5 minutes or lower maybe, patterns doesn't work in those way. So what are your views on the open and close, which forms a candle? I mean, in a 5-minute chart, 5 minutes is set by me.
Right.
If I take 2 minutes from this 5 minute and 3 minutes from the previous 5 minute, I get a 5-minute chart.
Right.
A day cannot be split.
Yes.
A daily bar has huge importance in candlesticks, I admit. And whatever techniques you have shown on an end of day basis, they are tested, tried, superb. But regarding day trading, how effective would they be? That's the major issue.
I use this for trading, day trading.
I mean, I have seen this.
Means we have 1 hour to cover. I take day trading sessions for 6 weeks. I can cover whatever plus I have to cover RSI. That's why I was fast. So I can discuss more intraday charts also and show you live examples also. So I was keen on putting the RSI part also in place. Otherwise I can discussing the day trading part. We can do that.
Yeah, RSI was good. It was very good.
So he can even combine that RSI logic.
This is a question. You are using it fine. I am.
It works equally the way it works in daily for me. And gaps are, if you are talking about EOD gaps,
But what
the same gaps in intraday.
What
Right?
about the logic for that open and close? I mean, which constitutes a candle body? Logic cannot be followed on an intraday basis. EOD
How
body,
is it different?
simply the opening and closing of a EOD bar is based on a logic on which a EOD candle is made that is not followed in intraday. EOD or intraday open is just the next from my previous bar, the next second. It's
Right.
based on time.
Right.
But when I am looking at a EOD bar in candlesticks, that's based upon whole night gets over, I get a good night's sleep, I go to the market, I have got some news, I have done some studies, I take an informed decision on the selling price, and I take a forced decision on the closing price.
Okay.
I'm clear. But on a day trading 5-minute or a 15-minute bar, there is no informed decision or a forced decision. It's just the last tick of that particular time frame. So can it have the same implication as an EOD open or a EOD close? That's what I'm aiming at.
Or I would say that I would not go into that detail, that is the implication, as long as it is making money for me without any kind of going detail of it.
A candlestick has an implication. If the
I got that.
implication is not followed on a day trading basis, on a daily, on an intraday bar basis, theory of candlesticks can't work on a day trading
So
perspective.
what I just discussed in day trading, I was not giving more importance to the bodies, I was giving more importance to the shadows.
Yeah, if a shadow you need a body, only then you can see the shadow.
Huh.
I am also not. What is a
We are looking at a small-
outside the body?
When you are looking at a small body, when price goes up and makes shadow and comes and closes lower, that means there is a supply. That much you agree?
If I get a
On that
shadow,
time
if
frame.
I get a shadow, I am getting a body. A body is open and close.
Yes.
So my shadow is also a function of my either open or my close.
But what is the other way
I have
out?
an up shadow. It's high.
What is your suggestion to use on day trading?
I mean, my suggestion is on day trading we can have different methods, but does pure candlestick work in those methods? If you use momentum indicators with it, on a resistance you get upper shadows, that's a different issue. But
Hey, 1 second.
Yeah.
1 second. Yeah, you were saying something? Yeah, Mr. Sriram.
Do you have time for all those? Having 3-4 oscillator, indicator, averages. See, have to keep you simple, stupid, so that
sir, I want to keep it simple, but I'm not ready to be a stupid.
that's a choice that one makes when you come into trade. That's a choice. That's a choice.
And I believe we are having a dialogue here, not a monologue, on a sonic way. Thank you.
So I know next to nothing to in trading. I'm quite new to trading, but
Right.
I've been following this.
Right.
And basically, even though I'm a doctor, I'm a research person, R&D oriented person. When I went looked at the charts in the boarding, I look at it only in that way, trying to learn something out of that.
Right.
Because this is totally entirely new. But from what I know, I only see that the candlestick pattern is totally erratic and randomized, and it only rests on investor or trader psychology. Simple. What we've been saying like greed and fear, that dictates it. There's absolutely doesn't seem to be any logic behind what is going on except that everybody wants to make money at different levels. That's it.
Right.
And fear dictates action. Greed dictates action. So I totally agree with, but what I'm saying is that doesn't seem to be any logic because you see so much of fluctuation in the price index in a single day. So it can't be happening on an EOD. No, I mean the EOD data and this cannot be the same. That definitely, that's for sure. That I see. Like if you take a crude, one day it is almost $3,000 high, the next day $3,000 low, and in between it could be anything. But it doesn't happen on the whole. If you say, I mean, the EOD data, if you see that, I think it's entirely different. So if it is so, I think that there is no meaning to it, number one. It is purely dictated by trader sentiments, I would say, number one. Next, I would like to know what's the logic of your question. Does it really matter? Well, candlestick, the opening and the close, it only indicates at what position everybody wants to take. Whether they want to exit or want to enter, the candlestick dictates only that. So I want to know the significance of your question, number one.
You can take that significance post the session with him. And what is
One
your
question to you,
Ah,
one question
yeah.
to you. This shooting star pattern, you say that usually that indicates a downward trend.
I don't say that it indicates a downward trend. It says supply, and if it confirms the next period, then it means confirmed downtrend. If it remains up and it crosses the high, it becomes a momentum trade on the continuation side.
Yeah, that's
We
it,
discussed both the
Vishal.
parts
That's
of
it, Vishal. How can I be sure by what it indicates really? So is there anything, any
You don't need to act in anticipation on shooting star. You have to act only if the low breaks and if only the high breaks. At shooting star, I have no idea whether it's going to work up or down. That's why I said I have to have a two plan. I don't go with one plan. Yeah. Only one candle. If you have a shooting star, if it breaks the low, I short. I just explained that thing, right? And if it breaks the high, I buy. Yeah. You have very little time to do incision analysis on day trading. Okay, you have very fraction of minute or fraction of second to take that trade. If your logic about candlestick or your whatever tool you use on day trading is not absolutely crystal clear, then you should not be doing day trading. If it is followed by a 5-6 bars of rally and then we see a shooting star, then it calls for a short if it breaks the low, and if it breaks the high, it calls for a momentum trading in the same direction. Any more questions?
See, it would have been better, Vishal, whatever slides you have showed you, the same thing could have been discussed over the live chart, real chart, then we would have understood a lot of practical implications which could not be covered in this theoretically made slides.
I'm okay, I'll open the live charts. Any other question?
What is the profitability of your economics?
It depends on the trading capital, the frequency of trading and the exposure you take.
Can you take one example and tell what is the utmost profitability?
Let's see one or two trades on this. See, I was also not keen on doing day trading seminar. Okay, but here every other topic was taken, so I was given day trading. I would love to have the same kind of whatever you learned in candlestick, don't apply to day trading, apply to EOD. Okay, if you are not convinced about it, it's okay, absolutely fine. I am trading the same method, I am okay with it. It makes money for me, it's okay, right? So you can use on EOD, you can use on weekly chart, that's fine. Now, if I have less time, I have to go by 6:30. And I have to cover RSI if you are interested, or I go on day trading with more samples, more examples. So we'll go with yesterday's topic of RSI. Some of not present, I guess, but then you'll have to catch up. And in fact, the DVD which has been distributed in your kit has 3 sessions by me of 45 minutes. One is on RSI, one is on trend following system, and one is on candlestick again. So you can even refer to that. So let's see, what we saw yesterday was the conventional use of RSI, which is, I feel, outdated, which I no more use, 70-30 overbought, oversold, or normal regular divergences. Okay, so we were looking at some unconventional use of RSI, which was called the range shift behavior, which is your 40-60, which works all time frames. How to enter, exit, I explained you the 5-star signals also, that what is a 5-star buy or a 5-star signal which is a sell. Any doubts on that? So we had these ranges which are working in bull market, bear market, or sideways market, or extremely strong uptrend or extremely strong downtrend. Clear? So we saw how a range shift happens. So we go to those examples which we were discussing yesterday. This is where you can see that we had a chart, weekly chart, where your RSI does not go below 60. That means extremely strong market. And then it goes between this 40-60, that goes for a sideways market. Again it gets into a strong uptrend where it goes 4, 5 and 6. Strong market, and then it goes this 6 point, which is almost near the high or a lower high, which says I'm not going up or I'm not no more bullish. So that's a exit signal at least on this time frame. And then it goes 6, 7, 8 into a down to a sideways market. Again it manages to cross 60, and since then it is up, and this 10, which says, which is very close to the previous top, says I'm not going up. Not going up does not necessarily again mean going down. Okay? And the same thing was there on a monthly chart again. One is 40, which is the lower part of a bull market, taking support on 2, which is 60, which is the strong uptrend, because 60-80 is a strong uptrend. So from 2 to 3 and then comes back, and 3 says almost same top, and 3 says I'm not going up. So from 3, 4, 5, 6, 7, it's downward to sideways. 7 crosses up 60, so bull market starts. 8 gives you a dip to buy again, then 9 gives a dip to buy again, and then 10 finally says not that much bullish, but it does not enter the bear market. It exits the extreme strong uptrend which was there since 5 years. So I can take it as an exit here. Okay? And then the same rally, it almost touches 60-65 levels and comes down. So this is a chart of Bale which was pre-split. And then what happened in 2010 and 11 to Bale is it came all the way back to this, which was signaled right at the top of the market. Okay, so yesterday we did range shift. Any doubts on that? Now we have a new concept, or maybe new to few of you. It's called reverse divergences. We know the normal divergences which we saw yesterday. So we look at reverse divergences. Now what do you mean by reverse divergence? So let's see what is first normal divergence. In a normal divergence, price makes a new high and RSI makes a lower high. That's normal divergence. Now in reverse divergences, price will not make a new high, whereas RSI will make a new high. You get that? I'll show you an example. Now, as I said, normal divergence is kind of obsolete. Divergence work, but under certain specific circumstances. Okay, I'll show you some of the divergence, and this is the downtrend in 2008. This is one divergence, this is another divergence, and the trend continues down. Nothing can be done with these divergences. This is a trend up, this bearish divergence, bearish divergence, bearish divergence, trend keeps going up. Normal divergence, right? Now we look at reverse divergence. It is a concept coined by Andrew Cardwell, who after Wells Wilder has been working extensively on RSI since last 30 years, only on RSI. And he has come up with the concept of reverse divergence, which I'll explain now. Reverse divergence, price makes a lower high or a higher low, and RSI makes a new high or a new low. This is reverse to normal divergences. This situation is, let's see, the picture makes more sense. Let's see positive divergence or positive reversal. Reverse divergence is known as reversal. Okay, we see price is making a higher bottom, whereas RSI has made a new bottom. Now what does this mean? Your RSI has already reached oversold and price has not broken previous low. Bullish, bearish. Right? It's written positive reversal, so it has to be bullish. But understand the concept that in an uptrend, you get positive reversal. How do you get divergence? When do you get positive divergence? In a downtrend. And negative divergence in an uptrend. That means whenever you are trading divergence, you are going against the trend. But when I am trading reverse divergence, I am going with the trend. I will get the trade in the same direction. Let's see how. Is this an uptrend? Clearly, A to B higher bottom, right? Sorry, B to A and B to A lower. So RSI went lower than the previous bottom, but price did not make a new bottom. That means what? It has already reached oversold at a higher level. Anybody not with me? Bearish divergence. When you look at traditional divergence, you look at the tops in an uptrend. Okay? That's absolutely fine. See, that's absolutely fine. If you can follow the price and make money, no need for any indicator. That's absolutely fine. No, it happens. You can have only price strategies like he has, 3x5. He does not look at any indicator. You have a method to trade price with rules, you can do it. So we have, what does this tells me? That market has got oversold in terms of momentum, but the price is still higher. That means it is bullish. Okay? And that keeps me with the trend rather than telling me to go against the trend. If you notice, there is a divergence also, traditional divergence. If you compare the highs, there is a normal divergence also between these two tops. So if I am looking at divergence, what am I looking at? Downtrend. If I am looking at reverse divergence, what am I looking at? Is continuation of the same trend. And to me, as a rule, I follow the trend, whether it's RSI, whether it's candlestick, whether it's reverse divergence. Okay, so this, I would be happy to be in the trend which is there rather than short this something which is going up. So if there is it's reverse divergence will always come in an established trend. Okay, once established trend is there, then it's very easy to trade. What is most difficult to trade is the turning point, which most people in technical analysis or as it is traders are looking for. Market will turn from here and market will turn from there. It will go to 6,000 and then turn, or it will turn from here, rather than looking at what is the current market doing. You follow the current trend. Till the time it does not reverse, why you need to go against it? See more examples. Throughout uptrend, you have this is a weekly chart, you have a decline. Your RSI goes lower than the previous low, but price does not go below the previous low. That's positive reversal. How will you trade that? I will show you. But let's see first the concept of that. Okay. Then we look at negative reversal. When price does not make a new high, but RSI makes a new high, that means you are overbought at lower levels. That is bearish for the market, which goes with the trend in that direction. It will not appear in an uptrend. It will only appear in a downtrend, which confirms that the downtrend is on. This is the same chart which I showed you for divergences earlier, which had divergences here. See this. And now you can see the reverse divergence in the same chart, that this to this is lower, but this to this is higher. This to this is lower. So you got overbought at lower levels, and that keeps the trend in the same direction. Price is the key always. Yeah, that's. So I need to show you more examples. Let me figure out. Let's see some live examples right now. Let's forget about that. What is an established trend currently? Any stock? Let's look at established trend would be, say, Grasim. All right, clear? Can you spot reverse divergence here in the same direction? First of all, in this stock, what I should be looking at? Long or short? So how will I get it? Look at the bottoms, okay? Bottoms of price, bottoms of RSI. Okay, let's see this. Here there is some bottoms of RSI, this small peaks, and here there is a dip in price, which brings the RSI lower than the previous peak. Previous bottoms. So this is a reverse divergence in this chart, which calls for another high. And if you notice, right now there is another reverse divergence in place. If you look at this and this is lower, and this is higher. So it has been more momentum is shown on the downward trend, but the price has not gone down. It's like oversold at higher levels, right? So this is another entry point to be in the same direction. And apart from that, what we learned yesterday, it takes support at 60. And its weekly chart is also above 60. And its monthly chart is also above 60. And it's an all-time high. So I would be up if I am looking to short this. So this is reverse divergence. Bottom to bottom, bottom to bottom. Positive reverse divergence, or you can say reversal. You have to change that mindset. That's why we are here, to give you the new perspective of RSI. See now what we are looking here. This is lever. If you can see, this is a divergence, okay? Normal standard traditional divergence which is in place. Am I going to short this? No. First of all, it is above 60 on all time frames. I would be looking for a buying opportunity in this by way of what? If it comes down, this RSI goes below than this previous peak, but price will definitely not go below this, and it turns up, then that sets up for a reverse divergence, positive, and that gives you an entry in an existing uptrend which is very easy to trade. Right? Any other stock? There are right now not that bearish stock where we can have reverse divergences on downside, but I can show you past instances like this. Okay, yesterday we discussed that reverse RSI range shift in Reliance Infra. This was a strong downtrend which we saw that weekly it is below 40 for 1 year. Okay, and every rally, compare this peaks of RSI which are higher than each other, right? This RSI is higher than this, but same price is not higher than this. That means it is overbought at lower levels, which sets up for a negative reverse divergence which comes in the same trend, and it says that there is one more new low which is going to be made. Whenever there is a reverse divergence, the low between the reverse divergence is going to break. Okay, that's the target. So if I am here and it starts turning from here and I see this candlestick pattern, if I normal divergence, how do you trade? By drawing a trend line, breaks, you trade. Simply if I draw a trend line, breaks, I trade, and I get a new low. Again it goes up here, makes a RSI which is higher than the previous RSI, but price is much lower. Right? That sets up, the trend is still down and it will call for a new low, and it makes a new low. And if you see this throughout, you have divergences also. So now you look at divergence or you look at reversal. Now, okay, first, everybody is so much gung-ho into about divergences. When we see a negative divergence, traditional negative divergence, what does it mean? Loss of momentum, right? Okay, now understand why would a divergence occur? Why would a divergence occur? Logic behind that? That is the conclusion you are taking from a divergence, but technically how does divergence occur? Okay, what RSI we are using or whatever tool we are using? 14 days. Okay, and RSI has a limit, banded 0 to 100. Everybody with me? 0 to 100. Now we have taken 14-day RSI, which is like we are taking about 14-day cycle in terms of price. Now market does not know that we are using 14-day cycle. If market goes up by 25 days, where will RSI go? It has to show a divergence. Then what I am trying to say is, if there is a divergence, how will a divergence appear if I am using 14-day RSI and market goes up by 30 days? There is no choice but a divergence. No choice but a divergence. So what does that infer? That the market is stronger than what we think or what cycle we are following. So how long you will keep changing the time frame of RSI? You don't know what the cycle market is following. How do you know that market is going to go up for 30 days or 50 days? Might not, if the cycle is less than 21 but more than 14, then there won't be a divergence on a 20-day or 21 RSI. But let's first focus on 14-day. Let's get clear with that, because most people are using 14-day. Till the time you don't master 14-day RSI, don't even switch it. All stocks, wherever the reversals, see negative reversal. We have crapped the oversold and overbought funda yesterday. So there is nothing overbought, nothing oversold. So that is out of the box. Below 40 it's bearish, above 60 is bullish. There is overbought, oversold. It remained in oversold for 1 full year. Price went up to half. What did you do about it? If you think oversold, you would have not touched it, or you would have bought it. Whoever does whatever does in the market will be reflected on the charts. We don't know operators personally what they are doing, but collective action of people is reflected on the charts. Now it's operator, if it's FII, if DII, or it's retailers, we are not concerned. We are looking at price action and what it enforces. Divergence clear? Still doubts? Divergence is good. That's it. Yes. Divergence says trend is strong. It can be 360 degree from what you used to think till now, but it is the fact. You think yourself logically how it appears. Last 5 minutes for this.
Can you elaborate the price action between the second arrow and the third arrow?
Second and third.
Here we have a new high after the second arrow. Yes.
This is RSI somewhere around 40.
Yeah. Then again the RSI went to 40 again. Yeah.
40 resistance means what? Bullish, bearish?
Bearish. Then next. After
This.
that, it makes a new high, and the price is also making a new high there. On the
Price is making a lower high. You compare this to this. This is the high. It's not this. I mark that arrow.
yeah.
This is the high for this RSI.
Okay. Okay.
It's clear?
Yeah.
Okay, let's see 2008 divergence is what you are talking about. I when did you see first divergence? Right? What is that level? Around 5,300. Then how much Nifty went up? And can you see reverse divergence here? You compare the high, you see divergence, you compare the low, you see reverse divergence. You want to see more? See this similar divergence in 2010. Okay? See this. One high, market, excuse me. One high, lower, 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 higher, 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 multiple divergence, absolutely dangerous. Market will crash to 3800. Right? That was the view at that point of time. Okay? Now you compare the lows. Each one is lower than the other, and each high is higher than the other. The same chart, you are looking at a divergence, I am looking at reverse divergence, and we both are trading. That's why any form or any tool, if the whole world looks at RSI, everybody will interpret differently, and still market will function the way it functions. It's not the tool, it's not the chart, or it's not the charting software, it is how you interpret. You don't need fancy tools or fancy softwares. RSI can be plotted on websites also for free. It's a basic tool which every software will have. And you don't have to tweak around also, you just have to use 14 RSI. You don't need to put any moving average on that. You don't need any extra information on that. Simple plain RSI, that's it. Hidden divergence will keep you with the trend, and normal divergence will tell you to go against the trend. I am not saying that complete divergences will not never work. There is a certain way to trade divergences. Now I am out of time to discuss that. Okay. Only from this session of RSI, what I want to suggest is you choose one tool, whatever you like. Whatever you like. I am not suggesting RSI. I like RSI, but you might like stochastic, you might like MACD, you like anything. But just go deeper into that. Get the skin out of it. What all possibilities or whatever books are available on that particular tool, whatever concepts are there, whoever is the author, catch hold of him, get all the structure out, all the stuff out, and then practice and do the same thing. What does that Bruce Lee had a famous dialogue that I don't fear who has 1,000 different kicks, but I fear who practices the same kick 1,000 times. You get that? Get one tool and get to the core of it. That's it. Any one tool. Simple and clear. Compare the lows. This is a trade setup. This to this, this to this, this to this. Every time there is a reverse divergence, you draw trend lines in normal divergence, you draw a trend line like this. If that cross, that's a buy, and you are going to make a new high between the two. And we also have a formula to calculate that how much high it will go. But I really don't have time right now. Okay. I am supposed to make a 10-minute presentation on what our company or what our institute offers and what kind of programs we have. So that will do, and I have to rush up to airport for my flight. So that's it for RSI, that's it for candlestick, and I'll just brief you about my stuff, what we do at Mumbai. As I already introduced, I've been doing since a very long time, since almost 18 years, and training at several corporate houses, management institutes, and I have my own small institute where I train people to how to trade. We offer several programs right from zero level with basic program where we cover the basic tools of technical analysis called like support, resistance, trend lines, moving average, patterns, Fibonacci, RSI, the normal RSI, and then we have advanced program with the advanced concept of RSI, Bollinger Band, advanced option where we have a special program at options. As I saw the presentation of AP, I also don't know anything about Greeks. I don't know anything about open put call ratio, volatility, implied volatility. I tried to learn, but it didn't fit my mind. So what I did is, what is my forte is RSI, my forte is Bollinger Band. So I trade option exclusively based on these two tools without looking at anything else, and it's a structured objective strategies. When RSI is such and such, then you buy option or sell option, or when ADX is this or when candlestick is this, I trade purely on my tools options without looking at even option charts. And then we have a program on investment psychology and trading psychology. We work on the mental aspects of trading, which I have conducted for even corporate houses like ICICI Bank and Bank of America. When I go there, they tell me that we know all the systems and all the tools. We want psychology program, how to control the emotions, how to control the mind. Okay, and we have a special day trading program, as I said, where I train people for 6 weeks. 2 weeks I train them on the tools and techniques. Another 2 weeks I trade live during 9 to 4 in my office with markets on, and I trade simultaneously with the student and show them how I apply tools which I taught. And another 2 weeks online support. And the main program which we offer is something called as mentor program. Now this idea came up like I got married 6 years back, and my wife was a lawyer, is a lawyer, and she was working for the legal department of Kingfisher Airlines 6 years back. And her job was 9 to 9 and traveling and all. So after marriage, she took a break for 6 months. So then for her it was, I was what? Speculating, gambling and markets like a monster to her. So in the break, I told her that you learn at least some few basics about this so that you know that it makes sense what I'm doing. So she learned a few things, then she was interested, she took it further and she did CMT, and now she's a trader, pro trader, as she sometimes outperforms me also. She trades international currency, I trade equity and commodity. She also trains. So from there the idea I got that if I can train a non-stock market person to a trader, then why not others? And the same thing I have been in my journey of technical analysis. I have attended hundreds of seminars and tools and techniques I have learned. And problem with 1 day, 2 day seminar is, like you are going to experience after this, is that you have got new tools and techniques. Tomorrow onwards you go and start trading them or applying them, you will have hundreds of doubts, questions, ambiguities, and whom you will call. How many doubts will clear, right? So similar problem I had faced, so I wanted somebody who can guide me through the process of trading successfully. So I caught hold of Larry Williams and Alexander Alder, and I did their extensive program, mentor program. It's a damn expensive for a shorter period of time, but it solved my problem. And then I made into that successful traders league. So similar thing what we offer is the same tools I teach in a mentor program, but the difference is throughout the 6 months or 1 year program, I guide on each and every trade you do. Single trade, whatever you do, like I just taught you RSI, you have hundreds of doubts, I am sure about it. Even I had. Now how will you solve that hundreds of doubts by losing money? Not a wise thing to do. After the seminar, whatever theories and discussed here and you trade, and whatever money you lose, you add it to the cost of seminar. Right? So we do an extensive program called mentor program where to create professional traders, to give you the freedom of time and money. I have trained certain people who are doing high paying jobs in certain banks for working for 15 years. Now they have left their jobs and doing only trading. They are making equal amount of money, but the most important part is time. They used to work from 9 to 9, now they work from home with family and 3 hours a day. Put orders, put stop losses and free. So most important about trading is it gives you the freedom of time, being a trader. And also to create awareness that trading in financial market needs training like in any other profession. We take trading casually, right? We have, if you take any other profession, doctor, lawyer, engineer, any other profession, everybody before minting money the way they do, they have to go through 3, 4, 5 years of training, then 1 year of practice, and then they start their own stuff. So if you take similar way, you need training in stock market. Formal training, formal education, that's the right approach to any profession. Then you will be paid as a professional in stock market. If you take it as a part-time job, if you take it as a gambling, as a hobby or as a speculation, it will pay you like that. Right? So that's the vision for us. We do this program. I am the chief mentor for this program, and my wife also takes few sessions, the basic stuff. Done MBA in finance and chartered market technician. I already explained about CMT. What is CMT? It is worth taking a look at what it offers, and because it's a regulated, it is offered by a regulated body and it's been recognized by all stock markets of the world. Trading since long time, corporate trainer. Why mentor? You need coaching, practice, motivation, focus, right? And on the job training. As I said, after this, if you have tomorrow doubts, you don't have anybody to ask. On the job training is required. Every single trade you do, I will guide you on RSI or whatever tool I teach. First part, as I said, if you have been around this, my logo says success in trading is not only about tools. You have hundreds of tools, hundreds of systems which are damn simple to use, but you miss the important part. Tools does not make money. Systems does not make money. Then you have to convert them into a trade setup which is objective, buy, sell, exit, stop loss. And then third part comes, how much to do? What is the quantity I would like to do? That is the third part, and the last part is how to manage the emotion during that period. So that 4 parts equals to successful trading. If you focus only on tools, you become good analyst. Good analyst. Okay? Hundreds of people are fantastic analysts but bad traders. Or not trading at all. It's nothing wrong, but somewhere they have faltered on the other 3 aspects of trading. Maybe money management, maybe emotions. Okay? So not only focus on tools, don't be hungry for more and more tools and techniques. Every tool is perfect, works fantastic. In level 1 analysis, we teach the simple things like trend line and supports and oscillators. Then we teach momentum and time cycles. We do also time analysis, which very few people, I guess, do in India. That like we do price analysis, that what are we expecting on the price, targets. We also have time targets. What are we expecting? When are we expecting? On which day or which month we are expecting a turn, right? And candlesticks, as I said. Then we have derivative strategies, option strategies, exclusively using our tools, no complex Greeks and stuff. System designing, I already give you my system which I am trading currently, all the systems, and plus help you to design your own system. So maybe any system which works fine for certain period, you have to tweak it. It will not work lifelong. Some parameters, some modification has to be done which you know, you should be able to know. Then only you can survive. Then we design system parameters, backtesting, lots of backtesting has been done on systems, and then system for trend in markets, we have different system for trend in market, different system for sideways market. So all this is like a comprehensive thing, you can deal with any kind of market or any market in the world with the same tools. Like we have this trade management, we have entry parameters, exit parameters, stop losses of 3 different types, trailing stop loss, time stop loss, and monetary stop loss if there is a re-entry or a review. 2 minutes. Then we have risk management, we have how much capital you will allocate, then what are the asset classes you will be trading, equity, commodity, currency, how much you will allocate to each asset class, and then managing the drawdown, how will you manage the drawdown, risk, portfolio risk, we have a whole portfolio risk. What do you mean by portfolio risk? That if I am holding X number of stocks and my portfolio is say 1 crore and I keep a stop loss of 15%, any given point of time, any single day if I am down by 15%, simply exit all. That means I am on the wrong side of the market. Then I will analyze what happened. And managing drawdown and trade risk, per trade risk, and then time risk. Then within what time I can lose what amount of money and manage it properly. Then emotions, most important in motivation, internal, external. Then we use goal setting, your trading goals for the year, trading goals for the next 5 years. How do you write them down and then work on them on a month-on-month basis. Dealing with market anxiety, trading injuries. Trading injuries means the losses, or it can be a bad trade, it can be a losing trade, or it can be some uncertain event which happened because of which you have to face a loss. That's a trading injury. News and views, greed and fear, losing streak. How do you deal with a losing streak in the market, which is often which is a part of life? Huge winning streak also. Whenever you have a huge winning streak, what should you do? Holiday, take a break. When you are losing streak, you don't need to be told to stop. Right? It is most often when you are doing extremely well, that is the time you are likely to the biggest mistake. Right? And how to deal with sideways market. And then program training period is 6 months. First 3 months we train you on the tools and techniques. Next 3 months we train you on the job trading. And the fees for that is 5 lakhs and registration is 2.5 and every month is 50,000. So that's the program that's the flagship program we run. And apart from for other special features is training during live markets. I will trade simultaneously with the same system, same tools, same stocks with you on my account. System designing, dealing with losses, guided trades throughout the year. For 1 full year, each and every trade you do will be guided by me. Full access to Malkan's library. We have around 400, 500 ebooks and full access to other research reports we publish I've been advising to a couple of brokers and also for some students and some clients where we publish some research reports, and that you will have an access to it. Prerequisite, it's minimum 6 to 8 hours every day of work. System designing, testing, reading, charting, and reading assignments 2 hours per day. At least need to read at least 15 to 20 books in that span of 6 months. Books on analysis, psychology, motivation and goal setting. So that's it for today, and we'll see you sometime in next seminar. If you have any doubts, any questions on anything on technical analysis, feel free to mail me, or my website is there on that brochure and all that stuff, and there is a DVD. So it was nice. I would like to thank DJ for organizing such a fantastic event. I've never seen this kind of participation and this kind of speakers in one forum, and it's been fantastic, and I loved being here and talking and listening to other speakers. Some new ideas I got and some new ideas I'm sure you might have got. And let's keep this going and continue for the next year also, and we look forward to Traders Carnival in 2013. Thank you so much.